Hi, everybody, and welcome back to EBnet Stream. We recently posted an article from Mergence Investment Managers on ESG in fixed income investing. I thought I'd catch up with Mohamed Ismail, who is the head of fixed income at Mergence, as the author of that article and unpack some of his thoughts in more detail. Welcome to EBnet Stream, Mohamed.
Thank you, Nat. It's a pleasure to be here.
Welcome, and I'm looking forward to this conversation. Your article was around the challenges in ESG in fixed income investing, but perhaps we can start a little bit before that. What does ESG look like, or ESG investments look like, in a kind of fixed income portfolio?
Okay, I think we can start with really first defining ESG, right? So the whole sort of idea behind this concept, ESG, environmental, social, and sort of governance principles, is to effectively promote responsible investing that leads towards sustainable investing. It is quite a broad framework, right? I mean, it does not necessarily only cover, for instance, fixed income. It's across all the asset classes, the investable universe that we as portfolio managers have access to, and basically the tools that we use to sort of construct our portfolios and to essentially create value for our clients. So ESG's involvement or its role in the portfolio is that added layer of, call it responsibility, that we expect from whomever we are lending money to in the debt space, for instance. So in fixed income, right, what we do is we have a framework, an investment process that evaluates certain investment opportunities, right? And those opportunities may be, for instance, adding some level of diversification in the portfolio that we want to achieve. But nevertheless, you know, there is a risk to all of that, right? So I'll give you an example. If we had to lend money to, say, Standard Bank, right? Or maybe not use a bank as an example, maybe a typical corporate. You know, what we want to do is we want to determine whether, you know, that corporate has that capacity or ability to repay the money that we've lent it to. But at the same time, we want to understand that its operations to generate the cash flows to pay it back, right, is responsible to the environment, responsible in terms of social welfare, and, you know, responsible from a governance point of view. You want to have a responsible board looking after its shareholder interests, and you want a company that operates where it takes into account, where it's aware of, you know, the environment it operates in, it's aware of the impact it has on people. And essentially what we want to sort of target is long-term sustainability in our returns that we offer to our clients. But at the same time, also that, you know, the space in which these corporates sort of operate in, right, they are doing so responsibly such that it benefits, you know, society, you know, overall.
So there's a lot in that, and before we get to the challenges, I'm going to pose one of my own by virtue of experience at a symposium I attended last week. It seems that the conversation is you either have sustainable investing or you have returns, and you've commented on both of those in your introduction. And I wonder if you could maybe elaborate a little bit more on that. Is it an either or is it a and?
It's both. It's and, because the fact is when it comes to assessing risk. Okay, so if we had to unpack it properly, right? As a portfolio manager, if you're looking at whatever sort of investments you're making on behalf of the clients, you have to sort of have your own investment process, your own framework in determining whether this is a suitable, qualified investment to make. And, you know, within that investment process, you have to consider then these factors, right? These sustainability factors. And as I mentioned before, right? I mean, there is a responsibility that these borrowers have, right, that they need to fulfill in order to sort of keep that, call it that that loan that we've provided, in a sense, for the operations to continue. There is a responsibility on their side that, you know, they do things that is aligned to those sort of good governance and social and environmental principles. That, you know, if they do that responsibly, we then will continue then to sort of lend money to them in order for them to operate. Okay, that's the one part. The second part is understanding now the investment value that creates, right? So in this investment process, we have to look at things very objectively And that will include looking at, like, profitability metrics, looking at your balance sheet, looking at essentially how does this company or corporate or institution run its business, right? And in those different levels, we'll then start to identify where, there are good practices and perhaps maybe practices that need to be improved. And that's where the ESG comes in, right? The bigger sort of problem now is that, we can use that as potentially a form of mitigation in terms of trying to understand what the level of risk we are taking, and then what we should be compensated for in order, from being exposed to that. But the problem we do have is, the models that we use are very traditional in the sense that we look at things very fundamentally in the credit markets. You're looking at balance sheets, financial statements, etc. But the more softer issues that are not present, how do you actually price for that? That's the big challenge. So going back to your sort of, early statement, it has to be sort of you need to look at things through two lenses. One would be, yes, the traditional sort of finance sort of way of looking at things, i.e. the fundamental approach. And the second would be kind of this overlay to that, where you a bit of a micro examination on good practices that will lead to, like I said, responsible undertakings by whomever the money's lent to, that they are going to sort of fulfill their obligations in a responsible way. And at the same time, they're able to sort of, satisfy the likes of us that essentially lend the money. Because, we want to see responsible investing being done. And, if they continue to do that, we can be, obviously ready to sort of provide that money for them. Yeah, but there, of course, there's another dimension to all of this. But we'll unpack that.
I wanted to jump onto a comment that you've made where you talked about in the fixed income or in the credit space. Do you look at ESG, or should investors or trustees look at ESG investing in the fixed income space differently to the way they would in the kind of equity space or in their normal kind of investment processes? Or is ESG wherever we invest?
I think fundamentally it should be universal, but it's got to come down to the actual risks that you are exposed to. So that's the big one. So if you look at the fixed income world universe, right? The debt space. Essentially, what are we doing as a fixed income portfolio manager? We are lending money, right?
Yes.
So if you think about it, we lend that money to whomever, a corporate institution, and under the obligations of that agreement, they have to pay interest and then eventually pay back whatever was lent to them, right? So fundamentally, there's the credit risk, right? So if you're lending money, someone's got to pay back. Now the question is, right, how are they going to pay back? And it comes down to their sort of operations, right? They'll generate their own cash flow from whatever or business activity that they do, and that's where we've actually did the homework, right? You do the due diligence on how they actually do that. Now, where the ESG thing comes in is, well, okay, you've got to understand how, if the sort of environment that they operate in, right? Are they doing things that are aligned to sort of those principles, those ESG principles? That's one thing, because it can jeopardize really the poor governance or sort of no regard for any sort of environmental concerns, etc. If they're poor ESG practices at that level, it could jeopardize us doing sort of future transactions with them. Meaning that if they struggle then to look for perhaps more additional funding in order to operate, the cost of funding will have to go up because there'll be less demand for instance, for their debt. So yes, that's where ESG is quite important because in our world, it's about really the credit risk, right? But not necessarily in a sense where, oh, okay, if there's poor ESG, therefore it means higher credit risk. It just means that the opportunity for finding funding in order to do your work, your operations, becomes a bit more tricky. And then they'll have to pay up the cost of funding that goes up alongside with it. And then, in the traditional finance sort of space, when you start to see rising cost of funding, it then translates into sort of poorer credit risk metrics, which is kind of now difficult to justify because perhaps the operating model is sound, but because of the poor ESG practices, it necessarily then forces a higher cost of funding, right? Because if you're not doing things the way you should be doing it, then no one's going to lend you money. So that's kind of the big issue, right? So ESG has its place in terms of pricing, but in the context of the South African markets, well, that's really where the challenge is right now. We aren't yet as sophisticated as perhaps the international markets are, but it's mainly because of the fact that we are a very smaller, concentrated market. If you consider who's actually in the fixed income market, right, especially on the credit side, these big income funds, they're massive, money market income and some bond funds. There's an overwhelming sort of demand for credit assets, but the supply is quite small and liquidity is quite thin in our markets too. So then, if the article kind of speaks about really what happens in terms of how do we adequately price then for that ESG related risk. And the sort of thing is, we found that with ESG issuances, it tends to sort of force the market to think that this is of a higher quality than it actually really is. And then the problem is you end up essentially buying these sort of lower yielding assets, which carry the same credit risk as they would without the ESG labeling. That's the problem. Yeah.
I was actually going to hit on that while you were explaining it. So perhaps if we could bring it down to something that's a little bit more known or comparable in a trustee's mind. If I invest in an equity of a company, I expect that company, as an active shareholder, I expect that company to behave, with ESG in mind. When I have a fixed income portfolio, I'm expecting the person who's extending the credit to do that assessment for me. Is that fair?
It is fair, because I think also it should be at the level of awareness, right? I mean, if I can just break it down to perhaps maybe the two levels of investors that we represent, right? There would be the retail investor and the institutional investor. Generally, on the institutional side, there's a bit more of an awareness toward these things, right? So, like as you mentioned, your board of trustees, they will sit, and then again, it'll come down to whether the board holds the management accountable, in the interest of shareholders, of doing the right thing. There's a bit more awareness there, and a lot more focus on ESG actually being implemented and truly being honored in a sense. On the retail side, I think a lot of the retail investors don't really have sight at that level, right? How it may impact their portfolios, and then they will leave it ultimately to the discretion of your discretionary fund managers, etc. Those guys to basically make the right decisions. Because remember, retail investors, when they sort of save in their portfolios, their objectives are very clear. They're looking for value creation. It's up to us in the middle layer to sort of ensure we are creating the value at the same time we are making responsible decisions. So we should not be, ESG. I think it's a level, it's a framework that holds it holds the market accountable, right? It's a fundamental thing to have in a portfolio, in terms of your responsibility, right? I think everyone should sort of align themselves to have exposure to best sort of ESG practices, right? But at the same time, just be aware of, like, if things are labeled ESG, have you done your homework enough to understand that you are not exposing yourself to a risk that is just essentially labeled ESG for the sake of it, right? In order to get access to funding, for instance, but fundamentally they're operating in the same way as they've done without the ESG label. That's our responsibility. It's very difficult to go and explain that to a retail investor, because I think they've got enough things to worry about. They're paying you to do your job, to do this for them. And on the institutional side, they're quite savvy and unaware, and they are more sort of holding these companies accountable for ensuring that the interests of their shareholders are well addressed in terms of whatever activity they're engaging in.
You talk about holding accountable, and I want to drill into that into a little bit more detail. So what I'm hearing from you is the holding of accountability when it comes to fixed income portfolios is in the interest pricing, and I'm not sure I'm using the right words, but the more naughty you are, the more un-ESG you are, the more expensive your credit risk is what I understand from what you've said. What other ways are there to hold companies accountable for ESG?
Okay, so what's interesting is if a company is looking to borrow money, I think essentially the ESG sort of framework creates a level of mitigation risk, right? A mitigation of risk. So if I can say this, like, so potentially what happens is if we were to sort of lend money to a particular corporate institution, before we actually get to that stage of the actual money transfer, we will have done the due diligence and identify potentially where we see these failures of ESG best practices. And what we would do is we would then work alongside, the corporate institution to say, if you get these things into place, right, it will then work more favorably in terms of, us lending you the money to do whatever needs to be done. So before we get to that point, the framework at least allows us, so the principles allow us to say, address these issues, because then we can mitigate risk around that. And then we can have essentially pure exposure then to really the operational part of things. But we know it's done in a responsible way, right? So there's one level where there's a bit of bargaining power with your essentially your lending market to say, guys, whoever's borrowing, you need to do it according to this, right? In order for us to actually sort of proceed. And you do find that companies and institutions do actually do that. I mean, there are responsible ones, definitely. But there are also those that kind of mislabel themselves as ESG compliant and, basically saying we are doing the following, where internally you might not even sort of observe those things. And a good example in the corporate space probably would have been Steinhoff, where they may have addressed kind of the more sort of, I think, issues that essentially the market wanted to see, but at the same time hide all the irregularities around the accounting, etc., which was not picked up. So there's governance problems everywhere, which could be masked, right, by potentially just labeling things ESG without actually looking at things properly, right? So for me, it's if on the debt space, if I just can bring this back, right, we have to tie in your ESG principles to the actual sort of risk return characteristics. You have to price for it. And in order to sort of get the pricing right, before we actually, kind of transact, you could use the ESG to mitigate risk in order to get a more favorable sort of outcome for both you and whoever you're lending money to, right? So that essentially, that will lead towards long-term value creation. Yeah.
If I was a trustee of a retirement fund, and I obviously know some of my investment portfolio is in this fixed income space, what would be the most important question to ask my fixed income portfolio manager?
Important question would be whomever you are. Okay, I'm going to bring in a bit of a technical term here. So trustees have a good idea of credit ratings, right? So, if we in the fixed income space are essentially buying debt across the market, they understand okay, what quality of debt are you buying, right? So they would ask us what rating of debt are you exposed to? And typically in the portfolios, what we want to do is we want to promote quality, right? We want to have something that's better than like a double A rating or A rating, something that has good investment grade sort of quality. We want to include that into the portfolio. Now, ESG can come and add an extra layer on top of that to sort of say, yes, we give it further sort of credences, in that this is a high quality asset, right? So then a trustee will come to us and say, okay, what credit ratings do you have in the portfolio? So what are you exposed to? If we give them a good sort of signal to say the portfolio is rated double A plus, they have a good sense of what the quality of the assets look like, right? From a credit ratings perspective. So ESG can help us also reinforce that rating, because there must be some level of, I'd say, alignment between the credit rating and then the ESG practice, because those two, like I said, credit risk is kind of linked between the two. So if we see positive ESG alongside a positive rating, then it's of a higher quality. That's on the face of it, right? On the surface level. The issues we do face in the market, though, is a little bit more, I think, a bit more complex, because what happens is when we have to sort of then go out into the market and compete now for these assets, like for instance, we have these sort of capital raises that are arranged by the banks, these auctions that do happen, where we as the sort of investment community will have to sort of bid for these assets. The problem is now it becomes a bit of a betting game, right? Because we have to then kind of put a bid through, not sort of betting, an auction, like we are bidding. It's a bidding game. So we're trying to we're trying to secure our participation, our allocation. So what we do is, like, as you've been to any auction, you submit the bid and the bids can go higher, right? So when the prices drive higher, it basically means that the spreads or the yields actually come down. So what you have then is a complete asymmetry on returns, or rather on risk versus return. So this is kind of the issue that we face in the fixed income market is, yes, we can have all the ESG principles aligned, we can have everything else aligned, but the problem we do have is then, are we adequately getting the right return for the risk we're exposed to? And that's kind of the challenge with ESG at the moment for us in the fixed income space, is that because of the demand versus supply dynamics, because of call it the market structure, right? The microstructure of the market, where you've got more concentrated buyers, you've got a lesser supply and overwhelming demand. You've got some corporates, using the ESG label just to get favorable terms for funding, etc. Those are all the sort of the problems we deal with, right? Outside of what ESG is meant to actually bring in terms of better alignment to investment principles. Yeah.
I imagine when you say bidding, I imagine literally a cattle auction where we're
Yes,
all
it's
sitting
like that.
around bidding on the
Yeah.
most beautiful cows, and to kind of just bring it home to that, I'm hearing you say that there is a sweet spot between what the cow is worth and what you bid on the cow. I mean, so if you had to bring that back to the fixed income market, there is a sweet spot in this negotiation between the pricing of the investment and then obviously the kind of future returns you might get from this investment. How varied are the spreads or are the returns from this kind of sweet spot price? Is this a prevalent problem in the fixed income market, or is it something that's an isolated auction here and there?
I think that's a nice way of putting it. There is definitely a sweet spot, right? So it's where essentially, we get an understanding of the correct risk returns. I would say risk return preference. So from the supply side, so that would be from essentially who's looking to borrow the money versus the demand side, those looking to lend, right? There has to be an agreement on where the risk returns sort of should sit, right? If you are able to sort of align that properly, I think the long-term value creation is sustainable. And when I say sustainable, it means that whomever we as portfolio managers are lending money to, right, we would want to do business with them going forward because we understand how they operate. We understand the cash flows that are generated in order to service the debt interest payments. But at the same time, we know that they are making positive strides to improving the overall sort of environment, improving social sort of structure, and improving and have sound governance sort of practices in place that will want us to always continue to do business. So in that perspective, right, that can lead to long-term value creation. The problem I highlighted is because of our sort of, I'd say, the market circumstances, right? It's more of I would say a structural thing where we've got an overconcentration perhaps of buyers, a very small limited market with thin liquidity to trade in, that we have these asymmetry of returns. And the one thing that bothers me is that, because now we are forcing sort of spreads to sort of be compressed because of this demand issue, it doesn't align well then with the risk characteristics. So I'll give you an example where it's prevalent, right? So if you look at DBSA, so DBSA did a sustainable sort of bond issuance in 2023. Now, when you look at sustainable sort of ESG related sort of bond issuances, right, you contrast that to sort of your sort of standard sort of demand for funding. So they have the traditional sort of series bonds, and then they've got this ESG related bonds. But then you found that the ESG related bonds actually price lower than the standard bonds, yet their fundamentals did not change. The underlying credit risk is still the same. So now you find that your corporates will want to issue more ESG-related bonds because they can get away with lower cost of funding, right? So they are those practices that now we need to sort of work with, right? That's why I'm saying ESG is a very powerful sort of framework if used correctly and responsibly and ethically in a sense, because you don't want someone just to sort of label their bonds ESG and because your mandates say you should hold ESG related sort of assets, that you are now all of a sudden just buying ESG related debt without actually doing the proper homework to understand what is the proper risk return trade-off over here, right? If it's not fundamentally changing, you should not be buying ESG. You should do the responsible thing for your investors, right? Because your objectives are to say, look for long-term risk-adjusted returns, sustainable returns that align well to best investment practices. You going after ESG-related debt because the mandate says you should is an opportunity for someone to exploit that situation. So those are the issues we face then, in the investment space. You may have sound ESG principles, right, that you understand it to be, but it just takes one or two sort of companies or corporates out there to kind of game that in their favor, where it kind of then skews things, away from you.
So once again, investors are cautioned to read what's on the tin and not always believe the label on the tin. Is that a fair way of saying that?
100%. But also, I think, from our perspective, because we understand, like I've tried to identify kind of these sort of factors, right? These challenges, is that, we should exercise a bit more discretion in the sense that if we are to sort of, I would say, bid for these assets, right? Because our mandates will say, right, we're very clear to say you should also integrate ESG into your framework, and you should kind of hold ESG related sort of assets. If you're going to integrate that into your investment process, I think then what we need to adequately do as portfolio managers, right, in our process is actually price for the risk, as opposed to sort of deem it to be a qualitative sort of factor where we tick a few boxes. If it qualifies as ESG, then we go for it. No, I think it should be priced for. And if necessary, it may even involve repricing virtually all the other debt in the market, right, such that there's a proper alignment to what is deemed to be sort of the adequate return for the risk that you're taking. If we do that, then I think all the problems should go away, right? But until then, we're going to have to deal with these structural sort of issues where potentially for me, I don't want to, I'm a firm believer in terms of sustainable sort of investing, but I want to do it such that I am responsible, right, for creating value for our investors, right? I don't want to just do it for the sake of being compliant to a mandate. It must align. Everything should align properly. And then from there, long-term value creation is possible. And I think there are studies that are done that actually shows that it is, right? ESG-related sort of effects on portfolio returns. I think it's still pretty much a nuanced kind of space, but it's growing. There's more research, more minds being thrown at it. And I think over time, we will definitely sort of identify how to adequately price for it. And then once that becomes part of our pricing models, I think there'll be more equitable sort of like fairness across investment decision making, as opposed to like one being favored. Like, for instance, a corporate sort of like, gaming the system to get cheaper cost of funding because you can label these bonds as ESG, for instance. We can get away from that. Yeah.
Mohamed, it's been lovely chatting to you today. Thank you so much for sharing with us the uniqueness of ESG investing when it comes to our fixed interest or our fixed investments. Thank you so much.
No, thank you, Natalie. It's been a pleasure. Thank you.